Prime Minister Datuk Seri Anwar Ibrahim reiterated the government's stance of not recommending a broad-based consumption tax like the goods and services tax to help mend the country's debt problem. He told the Dewan Rakyat that they will instead reduce subsidies to the rich as what they did with electricity subsidies. Anwar, who is also Finance Minister, was responding to a question from Taiping MP Wong Kah-Wah on whether the government would introduce any new taxes to address the rising debt service charge. Anwar adds that Putrajaya will seek to expand its revenue stream by growing the economy going forward. Anwar updated that the national debt level now amounts to 1.5 trillion or 82% of GDP, while the DSC in 2022 amounted to 41 billion or 14% of the government's revenue. He said the DSC is expected to be 46 billion ringgit this year, equivalent to 16% of the government's revenue. Meanwhile, Putrajaya MP Mohammad Razi Majidin also asked whether Anwar's decision to hold both the portfolios of the PM and the Ministry of Finance would be susceptible to abuse of power and eventually lead to more leakages. Anwar responded by saying there were leakages during the Perikatan National Administration when the portfolios of the PM and the MOF were separated. He says the issue is not whether the two portfolios are combined, rather the issue is abuse of power to rob the people. The PM also told the Dewan Rakyat that the Malaysian Anti-Corruption Commission is diverting its resources to focus on larger-scale graft cases to be more effective in fighting corruption, which he notes has become a systemic problem. He explains that in the past, too much time and energy had been spent on paying attention on the small fry, which he says is not effective. Therefore, the main attention of the MACC is now on investigations that are more effective in fighting corruption and at the same time restoring public confidence. Putrajaya is also looking to strengthen the Whistleblower Protection Act 2010 in hope of countering fear that may come with exposing corruption. Mr. DIY Group Malaysia reported a marginal increase in its net profit of 136.1 million for its fourth quarter, compared with a net profit of 134.6 million a year ago. This as revenue improved by 9.3% year-on-year to 1.07 billion, driven by positive sales contributions from new stores. Stores grew 20% year-on-year from 900 stores to 1,080 stores and led to a 15.2% year-on-year increase in total transactions. According to the group, profitability was impacted by the one-off Cukai Makmur and higher expenses. Mr. DIY still declared an interim single-tier dividend of 0.6 cent per share, which brings FY22's total dividend to 2.4 cent per share. For FY22, net profit increased 9.37% year-on-year to 472.95 million, while revenue also improved by 18.2% year-on-year to 3.99 billion from 3.37 billion previously. Group CEO Adrian Ong said the group is optimistic about its prospects going forward given the positive post-pandemic sentiment. However, he recognizes that there are still concerns on the impact on household income given the rising interest rate environment and increases in cost of living. The group has targeted to open another 180 stores in 2023 to bring the total nationwide network to over 1,200. Mr. DIY also expects margins to be sustained in FY23 following the price adjustments and the added benefit of an improving inflationary climate going forward. Asia Internet Holdings, the largest single shareholder in MyG Services, bought some 83.25 million shares or an 8.811% stake in point-of-sale system provider Kuskapi. Asia Internet bought the block of shares via the direct business transaction on February 10th, according to the BOS filing. It is not known from whom Asia Internet bought the shares. Coincidentally, offshore company Radioport sold out its 6.02% stake in Kuskapi, a separate filing to the exchange showed. Asia Internet is the private vehicle of MyEG's managing director Wong Tian Soon, better known as T.S. Wong. He emerged as Kuskapi shareholder in 2019. Wong currently holds a direct stake of 13.209% in Kuskapi and an indirect stake of 8.111% through Asia Internet, making him the biggest shareholder with a collective 21.32% stake. Kuskapi's share price closed 0.5 cent higher at 22 cent today. MyEG ended the trading session in the green, ending Tuesday up 3.3% at 62.5 cents, regaining some lost ground after the group announced that vehicle owners and drivers will still be able to renew road taxes and driving licenses through its existing channels. The counter, which was Bursa Malaysia's most actively traded, has been bogged down by heavy selling since last week, when news reports said that the Immigration Department could directly handle all immigration transactions from 2025. Wong, who holds a 12.13% stake in MyEG, bought 5 million shares in the group when MyEG's share price was heading south. Stronger domestic sales lifted biscuit maker Singh Industries' net profit for the fourth quarter by 28% year-on-year to 12.4 million from 9.7 million previously. Spurred by a 23% rise in domestic sales, the group's revenue for the quarter improved 16% year-on-year to 94.9 million ringgit. Singh has recommended an interim single-tier dividend of 1 cent per share for the quarter under review. Meanwhile, Singh's earnings for FY22 slipped 4.25% year-on-year to 26.08 million, despite a 7.56% increase in revenue to 318.2 million from 295.8 million ringgit. Looking ahead, Singh said it will remain cautious and vigilant as it believes FY23 will be a very challenging year in view of expectations for the highly competitive operating environment. The group said it will continue to monitor closely the environment of commodity prices, evaluate and adjust the pricing strategies when the need arises. Nevertheless, Singh said it will continue to maintain and improve product quality, innovate its products portfolio, reduce costs and broaden the distributor network to drive higher sales and growth in market share. Malaysian regulators renewed an operating license for Lynas Rare Earths Malaysian unit, but they retain conditions that will prevent Lynas from importing and processing rare earths concentrate after July 1st. This means that the Australian company will need to close the cracking and leaching part of its rare earths processing plant if the conditions are not removed by then, Lynas said in a securities filing to the Australian Stock Exchange. According to Reuters, Malaysia's government has raised concerns about radiation levels from the process of cracking and leaching. Science, Technology and Innovation Minister Chang Likan, in a statement on his Facebook, said that Lynas is not allowed to carry out any activities that will produce radioactive waste in Malaysia after July 2023. However, Lynas notes that 2 International Atomic Energy Agency reviews found the plant to be low risk and compliant with regulations. Lynas Chief Executive Amanda Lacaze said that after 10 years of safe operation in Malaysia, it is disappointed that the conditions that have been applied to its 2020 operating license remain. Lacaze said that Lynas will now proceed with administrative and legal appeals to ensure that it is treated fairly and equitably as a foreign direct investor and a significant employer and a contributor to the Malaysian economy. Under its new permit, Lynas will be able to continue other parts of processing until March 2026. Lynas had applied to Malaysia's regulator for the conditions to be removed because they represent a significant variation from the conditions under which Lynas made the initial decision to invest in Malaysia.